Assalamualaikum and good day. We are from Group 5 and we have selected SOX Berhad and Time.com from the telecommunication industry to be presented in our assignment. So I would love to talk about the SOX Berhad background first. So we are going to begin the presentation by explaining the company background of SOX Berhad first. SOX Berhad is a Malaysian telecommunication company that was launched in 2005. It became the first Malaysian MVNO to be listed in the Bursa Malaysia in 2009 and currently under the ACE market. SOX Berhad provide MVNE services, eSIM, IoT and 5G solution in Malaysia with approximately 2.5 million subscribers. Unfortunately, SOX is currently classified as PN70 company since January 2023 and might facing the risk of being delisted from Bursa. We also has done a SWOT analysis toward the SOX performance. As for this strength, they have a strong brand presence with 2.5 million subscribers, giving them a competitive edge and market recognition as the first listed MVNO. They also demonstrate strong innovation through products and targeted plans such as Mahasiswa and One Family. As for the weakness, SOX has suffered loss of 14.35 million in 2024, which is actually a continuous trend of losses from previous year. This issue might concern in the long-term financial sustainability as they are currently facing risk of its share being delisted. As for the opportunity, SOX introduced new postpaid plans such as Mahasiswa and One Family, which possibly cater to specific and high demand market segment. This also offer a clear path to subscriber growth and increase in revenue. Not to mention, they also can potentially attract tech-savvy customers through implementation of eSIM as well. As for the threat, SOX might face inter-market competition as they are competing with other well-established companies, and which led to limitation of market share and pricing power. They also exposed to the risk of cyber attacks such as phishing or SIM swapping, which led to negative image of the company and decrease in revenue in the future. So that's all for this SWOT analysis. We're going to move on to the next part.
Let's look at the common size analysis for SOX. First, the challenge is in 2024, our cost of sales rose significantly to nearly 58%, which compressed our gross profit margin down to 42%. However, the real story here is our operational efficiency. If you look at the loss for operations, we slashed it from 17.1% in 2023 to just 0.97% this year. We effectively eliminated operational waste. This discipline saved the bottom line despite higher costs up top. Our net loss for the year improved dramatically, shrinking from a 25% deficit last year to just 5.7% today. We are now much closer to breaking even. Turning to the balance sheet, we see a positive shift in our financial structure. On the asset side, our liquidity has improved. Current assets increased to 34.36%, while our reliance on non-current assets decreased slightly. The biggest improvement, however, is in how we are funded. While short-term obligations rose, we significantly reduced our long-term debt risk. Non-current liabilities dropped from 7.3% down to just 10.74%. This reduction in long-term debt directly strengthened our ownership position, driving equity up to 45.45%. Essentially, SOX is now standing on a stronger, more self-sufficient financial foundation.
So the next part is the point analysis. In 2033, the company had a negative profit margin, showing it was making a loss. Asset turnover was moderate and the equity multiplier was relatively high, which led to a negative ROE of 0.44. In 2024, the profit margin became more negative, but asset turnover slightly improved. The equity multiplier decreased, meaning that it lower leverage. Overall, ROE improved to 0.10, showing that losses were reduced compared to 2033.
Our 2024 ratios highlight a significant move toward financial stability. The most striking change is our debt-equity ratio, which plummeted from 0.44 to 0.04, effectively deleveraging the company. Additionally, our current ratio surged to 7.84, indicating an exceptionally strong ability to cover short-term obligations. Operational efficiency is also trending upward. Inventory turnover improved from 11.06 to 14.79 times, meaning we are moving stock much faster than last year. Meanwhile, our receivable turnover remains steady at 16.57, showing consistent collection performance. Finally, we've narrowed our losses substantially. Our net profit margin improved from negative 0.25 to negative 0.06, and EPS losses shrank from negative 40.08 to just negative 7.33 cents. XOX is now leaner, faster, and much closer to the break-even point.
Time.com Berhad is a premium Malaysian telecommunication provider headquartered in Kuala Lumpur. They operate their own proprietary fiber network and international submarine cables, serving retail, enterprise and wholesale market. Beyond core broadband and data center, they are now strategically diverse into green energy solutions, specifically home solar and EV charging. Looking at the SWOT analysis, Time's primary strength is its high-speed fiber infrastructure and diverse service range. However, a key weakness remains its limited coverage, which is heavily concentrated in urban high-rise and condominium, often leaving terrace house and rural area undeserved. Growth opportunities are significant in suburban expansion and providing customers digital solution for the growing SME market. On the other hand, the company faces intense competition from giants like Unify and Maxis, along with the threat of 5G technology, potentially reducing consumer reliance on fixed fiber broadband. On the income statement, 2024 revenue grew by 6.2% to 1.69 billion ringgit. Operating efficiency improved with results from operating activities rising to 26.1% of revenue compared to 24.1% in the previous year. While the total profit for 2024 appears lower on paper, this is due to a massive one-off gain from discontinued operation in 2023. Excluding the extraordinary item, 2024 shows a strong normalized operational performance. In conclusion, Time.com remains financially resilient with robust infrastructure focus and healthy improving profit margins. Our common size balance sheets reveal a strategic shift toward long-term infrastructure. In 2024, non-current asset increased to 67.1%, while current asset fell to 32.9%. While this reflects a heavy investment in the future, it has slightly tightened short-term liquidity, with the current ratio dipping from 3.8 to 3.45. But despite this, the capital structure remains very stable, with total equity representing a dominant 78% of total financing.
For DuPont analysis, we evaluate the performance of return on equity or ROE through three main components, which is profit margin, total asset turnover, and equity multiplier. Based on Time.com Berhad data, ROE shows a significant decrease from 0.61 in 2023 to 0.10 in 2024. This means that the return to shareholders will be much lower in 2024. The main reason for this decrease is the large drop in profit margin from 1.61 to 0.23. This shows that the company is generating much lower profit from sales compared to the previous year. Although total asset turnover increased slightly, indicating a more efficient asset utilization, and equity multiplier remained almost the same, this increase was not enough to cover the decrease in profits. In conclusion, Time.com's decrease in ROE in 2024 is due to profitability issues, not financial structure or asset efficiency. This indicates the company's operating performance is weakening and negatively affecting shareholder returns. Next, we look at the financial ratio analysis to assess the financial position of Time.com Berhad. For the short-term liquidity ratio, the current ratio decreased slightly from 3.81 to 3.5 in 2024. Despite the decrease, this ratio is still high and shows above the one that the company is still able to cover current liabilities well. The quick ratio cannot be calculated because inventory information is not disclosed. In terms of long-term solvency, the debt-to-equity ratio increased slightly from 0.27 to 0.28. But the debt level is still low. This shows that the company's financial structure remains stable. The interest coverage ratio is also increased, indicating that the company's ability to pay debt interest is stronger. For asset management, inventory turnover are unable to assess inventory efficiency due to missing inventory data for both years, and reservoir turnover also increased from 3.80 to 4.41, indicating that customer debt collection has become more efficient, thus increasing cash flow. From a profit perspective, net profit margin and ROA both increased, indicating better operating efficiency. However, earnings per share decreased significantly, indicating that income to shareholders are declined. Last one, the PE ratio has increased from 3.88 in 2023 and to 2.60 in 2024, indicating that the stock looks more expensive relating to current earnings, likely due to expectations of a future recovery in profits.
From an investor's perspective, XOX Berhad and Time.com Berhad shows very different risk profile. For XOX Berhad, the profitability ratios remain negative. Despite improvement in liquidity and solvency, the company continues to record losses. Interest coverage indicate high financial risk, so XOX is a high-risk turnaround stock and unsuitable for risk-averse investors. While for Time.com Berhad, the profitability ratios are positive with higher net profit margin in 2024. Liquidity ratios remain strong and well above 1. Low debt equity ratio and high interest coverage show financial stability. So Time.com Berhad offers lower risk and more consistent returns. In conclusion, although XOX Berhad shows signs of operational recovery, its ongoing losses and financial risk limit its investment appeal. In contrast, Time.com Berhad demonstrates a stable growth, strong profitability, and prudent financial management. Therefore, based on the ratio analysis and overall financial performance, Time.com Berhad is the preferred investment choice, while XOX Berhad remains unsuitable for investment at this stage. And that's all from us. Thank you.